certainly a topic everyone loves to talk about. How do you see the rising interest rates, really impact deal financing as one particular example, the overall state of the M&A industry this year?
I mean, rates are a constant topic in investment committees and boardrooms. The first thing to note is rates have already increased a lot. We were near zero at the start of 2022, and now like Fed funds target rates are, what are they? We're like just under 4.5%. Consensus is that we'll get to 5%, but we've already kind of gone a long way from where we were at. I think consensus, the market's saying we're going to get to 5 or just above 5%. Someone on CNBC today was saying, I think it was actually Jamie Dimon, said that he could see rates higher than 5% and for longer, but that's not what the market's saying. But when you look at those interest rates, higher interest rates, the direct impact is higher interest rates generally means less leverage, generally means lower valuations, right? That's just the direct impact of higher rates. Indirectly, it suggests that there's just a tighter credit environment. So it's just generally harder to get leverage on deals, which is all just negative for M&A. I still think every deal is unique, and we're getting financing on our acquisitions right now, both new platforms and add-ons, and lenders are open for business. It might be, the underwriting might be a bit stringent, but we're getting deals done. And just like private equity firms, private credit funds and banks, they're open for business, and they need to get new loans out to grow. But it's profitable for them if they can do a good job underwriting. They can lend long and borrow short still. And so I think the lending environment will be okay. Plus, we're talking about 5% Fed funds, and maybe you've got 7, 8 all-in yields on your bank debt or low double digits on your unitranche facilities from private credit funds. The LBO math still works. Maybe it doesn't look as good as it did in prior years, but coming from a private equity perspective, if your business is growing organically, inorganically, your returns are going to look fine. They're not going to look as good, but they'll look fine, and that's okay. Now, at the same time, if you're a business that was over-levered, and whether you were over-levered at the outset because a private equity firm bought you and they took a ton of leverage, or performance declined, so your implied leverage multiple went up, and now you're running into interest and debt service coverage ratio issues, that's another story. There's definitely going to be an increase in restructuring activity and a finer eye to what happens below EBITDA in the year to come.